On the morning of March 15, 1996, Fokker workers walked silently through the streets near the factory. The news they all feared had finally arrived. After nearly 8 decades flying around the world, Fokker, the ultimate symbol of Dutch aeronautical engineering, announced its bankruptcy. Inside the industrial facilities, several partially assembled Fokker 100s were abandoned, like ghosts of a project that promised much but couldn't sustain itself. An aircraft considered a technological masterpiece had failed to save the very company that created it. How is it possible that such a technically acclaimed airplane couldn't prevent the demise of its manufacturer? The Fokker 100 case teaches us much about how having an incredible product doesn't always guarantee business success.
If you're also passionate about the world of aviation, consider subscribing to the channel and supporting our team.
Let's go back to the late 1970s, when Fokker faced a crucial decision. The Dutch manufacturer had built its reputation with the F-27 Friendship and F-28 Fellowship models, but desperately needed something new to avoid being left behind. The 1973 global oil crisis had completely changed the rules of the aviation game, making fuel economy an obsession for all airlines. In 1983, Fokker officially unveiled its newest project, the F-100, which, like many others, promised to completely revolutionize the regional jet market. The aircraft would be capable of carrying up to 109 passengers on trips of up to 1,864 miles, 3,000 kilometers, perfectly filling the gap between small regional aircraft and giants like the Boeing 737 and Airbus A320. Speaking of technology, the Fokker 100 was practically perfect. Equipped with modern Rolls-Royce Tay engines, the aircraft consumed about 30% less fuel than direct competitors. Moreover, it was much quieter, something highly valued at urban airports with noise restrictions. At 52,911 pounds, or 24 tons when empty, the F-100 was considerably lighter than its direct rivals, which helped significantly with fuel economy and operations. The cockpit was another showstopper. It featured cutting-edge electronic systems for the era, including EFIS, which quickly became pilots' favorite. When the Fokker 100 took off for the first time on November 30, 1986, expectations were sky-high. The initial orders seemed to confirm the bet was right. Swissair ordered 8 aircraft, US Air placed an impressive order for 40 units, and American Airlines, a market giant, signed a contract for 75 aircraft with an option for 75 more. In 1988, when the first aircraft was delivered to Swissair, the future looked bright. Fokker dreamed of selling at least 800 units during the program's lifetime, which would put it competing head-to-head with the big market names. By 1991, the order book reached 202 units, quite attractive, but still far from the company's ambitious goal. The early 1990s brought the first signs that things weren't going as planned. The 1991 Gulf War sent fuel prices soaring and caused a global economic crisis. Many airlines found themselves in financial trouble, canceling aircraft orders. At the same time, competition was intensifying. Boeing launched the 737-500, a compact version of its successful family, while Canada's Bombardier and Brazil's Embraer began gaining ground in the regional jet market with cheaper and more attractive proposals. Fokker also faced serious internal problems. Simultaneously developing the Fokker 100 and its smaller sibling, the Fokker 70, had consumed a mountain of money. Between 1988 and 1991, the company spent more than 2 billion Dutch guilders, about $1 billion at the time, on both projects, an astronomical sum for a company of Fokker's size. The pricing strategy also proved problematic. Fokker had set an initial price of $20 million per F-100, well above some competitors. The company bet that superior quality and operational economy would justify charging more. In 1992, Fokker's financial situation went from bad to worse, and the Dutch government had to intervene to prevent immediate bankruptcy. The money came, but with harsh conditions. Fokker needed to find a strategic partner to take over a large part of operations. After months of negotiations, Germany's DASA, Daimler-Benz aerospace arm, bought 51% of Fokker in 1993. The deal seemed to be the salvation the Dutch company desperately needed. With DASA's financial backing and access to its global supplier network, there was renewed hope for the Fokker 100 program. However, the underlying problems persisted. Production remained extremely expensive due to high wages in the Netherlands and the appreciation of the Dutch guilder against the US dollar, the currency in which aircraft were sold. For each aircraft that left the assembly line, Fokker lost money, a situation clearly impossible to maintain long-term. Meanwhile, at airports worldwide, the Fokker 100 continued winning over crews and passengers. Its flight stability, low noise, and operational economy made it an extraordinary aircraft. Paradoxically, the same plane receiving enthusiastic praise was driving its manufacturer toward collapse. January 22, 1996, marked the beginning of the end. Jürgen Schrempp, CEO of Daimler-Benz, called an emergency board meeting. DASA, which had bought the majority stake in Fokker just 3 years earlier, announced it would no longer invest money in the Dutch manufacturer. Accumulated losses made the situation impossible to sustain. "Sometimes you have to accept when the battle is lost," Schrempp declared in an interview with journalists. "Our analysis shows that even with heavy additional investments, Fokker would hardly become a profitable company in the next 5 years."
The announcement hit the European aviation industry like a bombshell. The Dutch government immediately tried to find new investors, but limited time and the company's precarious conditions scared away potential buyers. Samsung Aerospace showed initial interest but gave up after seeing the company's numbers. Bombardier considered taking over Fokker but quickly backed out. On March 15th of that year, the inevitable happened. Fokker declared bankruptcy, although a subsidiary continued operating to support the existing fleet. The last complete Fokker 100, the 283rd off the line, was delivered in 1997, definitively ending an era in European aviation. But how did a technically excellent aircraft fail to save its manufacturer? The answer lies in a mixture of questionable strategic decisions, bad timing, and ruthless competition. A deeper analysis shows the Fokker 100 fell victim to what economists call the Valley of Death, that critical period between developing an innovative product and having it widely accepted by the market. Fokker invested more than $1 billion in F-100 development, betting that returns would come with hundreds of orders. However, initial sales, while promising, fell short of what was needed to recover the investment. The scale problem became evident when compared to major competitors. While Fokker produced about 30 aircraft per year at its peak, Boeing could manufacture 250 units of the 737 in the same period. This difference directly impacted unit costs. Without the benefit of large-scale production, each Fokker 100 component cost proportionally more. To understand the magnitude of this disadvantage, consider that the average development cost per seat in a Fokker 100 was approximately $917,000, while the same indicator for the Boeing 737-500 was around $550,000. This 67% difference was directly reflected in the aircraft's final price, and consequently in its competitiveness. Timing also worked against Fokker. The aircraft reached the market exactly when a global recession was deeply affecting the aviation sector. Between 1990 and 1993, American Airlines accumulated losses of nearly $13 billion, an unprecedented amount in commercial aviation history. During crises, financial flexibility and access to capital become crucial, and Fokker was at a disadvantage in both aspects. Another critical factor was the company's currency strategy. Fokker sold its aircraft in US dollars, but had costs mainly in Dutch guilders. Between 1985 and 1995, the guilder appreciated about 35% against the dollar, effectively reducing the company's profit margins to unsustainable levels. For each aircraft sold for $30 million in 1995, Fokker received the equivalent of 35% less in real terms compared to 1985. Competitive pressure was also intensifying. In 1992, Bombardier launched the CRJ-100, a 50-passenger regional jet that, while smaller, offered a cheaper alternative for low-density routes. On the other side, the Boeing 737-500 and Airbus A319 competed in the 100 to 120-seat segment with the financial and commercial backing of industry giants. Perhaps the most ironic aspect of the Fokker 100's failure was its superior durability and quality. Designed to operate for 90,000 cycles, takeoffs and landings, Fokker aircraft simply lasted too long. This meant the replacement market took much longer to appear, reducing potential sales over time. Nearly 3 decades after its bankruptcy, Fokker's and the F-100's legacy remains visible in the skies. In 2025, at least 58 Fokker 100s still operated commercially around the world, mainly with regional companies in Australia, South America, and Eastern European countries. 2/3 of these aircraft fly in Australia, including with Qantas, with Alliance Airlines operating the world's largest Fokker 100 fleet. The mystery of the Fokker 100 lies exactly in this paradox. How did such a technically excellent aircraft fail to generate sufficient financial returns? The answer isn't in engineering, but in the brutal realities of the global commercial aviation market. Looking back, Fokker made the mistake many technology companies repeat, assuming that technical superiority automatically translates to market dominance. In reality, factors like timing, production scale, cost structure, and financial capacity often outweigh product excellence itself. In a discreet hangar at Amsterdam's Schiphol Airport, a meticulously preserved Fokker 100 in original KLM colors serves as a flying museum and memorial to Dutch ambition in the skies. For engineers and former employees who occasionally gather there, it represents both pride and melancholy, a symbol of technical excellence that, paradoxically, wasn't enough to guarantee its creator's survival. The Fokker 100 story reminds us that in business, being the best isn't always enough to win. Sometimes the market rewards efficiency, timing, and scale over pure technical achievement. It's a lesson that resonates far beyond aviation, speaking to any industry where innovation meets the harsh realities of commercial competition.